Hello everyone, welcome to Just Invest Today. And today we're talking about Li Lu. He did an interview back at Peking University. This is back in 2015. He talked about the prospects of value investing to a group of university students in China. But the main thing I want to talk about today is what is the best asset class? And he talked about this in the interview slash article, and he got this information basically from a Wharton University professor named Siegel. And what Siegel did was he went back in the history of the US to see what asset class did the best in like a 200 plus year history. And that's what he could track, right? So he went back, he tracked that, and he wanted to know what is the best investment? What should we be looking into? So during this Peking interview slash article, he went through that. And guys, this is very surprising. This is really good news. I wish we knew this. I wish I knew this back in high school because I feel like everyone would be investing kind of differently with a different type of mindset. So let's get into this video and see what Li Lu had to say about this and what he had to actually put down in his article. So let's first get into it. First, he talked about the value of the dollar. And this is very interesting news. In this interview, Li Lu said basically, if you had a dollar today, back in 1802, and you kept that same dollar until 2014, that dollar would be worth 5 cents. You would lose 95% of the value of that dollar. Can you believe that, guys? And guys, that's all due to inflation. So a lot of people think that like having money is just safe in the bank and they don't want to invest it, they don't want to put it anywhere because they don't know what to do with it. And that's why it's so important to learn about investing. Guys, your dollar would be worth 5 cents in 2014 if you hypothetically were born in 1802 and held on to it for that long. Can you believe that? That's why it's so important to learn about value investing, investing in the market. So we can see that we know that we do not want to hold dollars. We don't want to hold dollars for too long. And guys, with what's going on right now and what we're seeing with the feds and with everything what they're doing with the money, that's just gonna go higher. That might be going up maybe 4 to 5% of inflation now. So your dollar is going to be worth less and less faster than that. So watch out about just holding dollars. Be precautious. We don't want to hold it for too long. So that's the first thing about the dollar value. So the next asset class is gold, precious metals, and silver. Everyone always thinks this is an amazing investment to preserve your wealth with. But if you look at the data, right? And this is going back, remember, all the way to like 1802, 1804. And remember, in that time, the monetary system was backed by the gold standard, right? But that was kind of canceled in 1933 and then finally canceled by President Nixon in 1971. So you can no longer just switch your gold back into the currency, right? You couldn't just do that fixed value exchange anymore. So with all that being said, guys, if you with $1 if you bought gold and then you held that gold until 2014, guess how much that would be worth? $3.12. So you can just see how that was barely anything. Basically just 3 extra money. You got a 3-fold return. Is that enough for you guys in 200 years? Is that enough? So think about that when you're investing in gold, right? But then again, what do you guys think about Bitcoin? A lot of people think that Bitcoin is going to be following gold. Like gold is like Bitcoin is the next gold. It's not like something that you can purchase with or you can buy with or you can pay your taxes with. And it will eventually just like kind of like follow like how gold plays out, like that 3% over time. Do you guys agree with that? Or do you think that Bitcoin is going to have way bigger returns in like the next 200 years, like bigger than stocks or bigger than like housing or something like that? What do you guys think about Bitcoin? So now we move on to Treasury bills and bonds. Treasury bills have been kind of higher than the inflation rate. It's it's like at level with the risk-free interest rate. So over that time, you would have 275 times your money. So that's a pretty good or like average kind of rating. And then with bonds, guess what? You would have had 1,600 times your money with bonds. So when you can see those two asset classes, you can see that was above gold. So it was above holding gold, and it's actually above actually trying to keep dollars to preserve your value. So the next asset class is stocks. And this is very important. So the analyzed return of the stock market since 1802 to 2014 would be 6.7%. So guys, if you held your money for 200 years plus in the stock market, you had a dollar in 1802 till 2014, you would have had a $1 million return with just $1. That just shows you the huge difference between stocks, bonds, treasury bills, gold, and all those type of asset classes. And this has should have been always taught in school, guys. Because remember, everyone always says that stocks are the most riskiest things. People don't want to invest in the stock market because it's so risky. I'm gonna lose money. But when you look back and when you see the data, stocks has provided the best returns of just holding your money in the stock market. This data just basically breaks down how important investing is and how it's honestly the best asset class to be into. And the two main reasons for this, guys, that the stock actually performs better than all the asset classes. One, the 6.7 return, discounting inflation, is amazing. And then the power of compounding that money year over year over year over year by 6.7% is amazing. And those people don't realize that just that compounding of growing your money every year actually has a huge effect, guys. It plays a big role of making a lot of money just compounding at that annual rate. And then the next reason is that the GDP, what comes with GDP growth is actually business growth, right? So we gotta remember that stocks is a part of ownership. When you buy a stock, you're buying ownership in a business. So as the GDP grows and as your business grows, that's been growing around 6-7% yearly too. So remember, stocks are gonna follow that growth because remember, stocks are related to business growth. So those are the two main reasons why this compounding effect happened and why that huge return, that $1 million return, if you held your money for that long, took effect. And to end this video, Li Lu brings us all back to one specific point and why value investing is so important and needed in this market. Think about it. The average investor invests for around 12 to 20 years. That's how long the average investor lasts in the market. And when you think about history and when you go back, look at the post-war period. From 1966 to 1981, you would have had a negative return. To 2000 to 2012, you guys, you would have had a negative return. So if you just invested in the S&P or you just invested in the market, you would have had a negative return. And that's all the time you last in the market, just that 12 to 20 year time span. So you guys, you would have had a negative return. You would have been screwed. You would have made no money. And that's not what we want as value investors. We always want to be making money, guys. So the most important thing you got to think about is you don't want to be stuck in one of those time periods. What if it 2021 to 2030 and 40, the market turns negative and you don't make any money just investing in the S&P? That's why it's so important to become individual investors, right? Because we don't want to be stuck in a time period where there's a negative return because it can happen. It's been like that. There's times in history, as you've seen, where there's been negative returns. So guys, that's why it's so important to be a value investor because guys, people like Warren Buffett, we have people like Warren Buffett, Charlie Munger, we have people that can actually make money during a downturn. Value investors actually make the most money. They actually do the best when there's kind of that negative downturn in the market. That's when they make the most money, guys. So it's always so important to look at people like Li Lu, Charlie Munger, Warren Buffett, and get that value investing lessons. What wasn't in this study was the housing market. I really wonder how the housing market would stock up to like stocks and to the gold and to treasury bills. Do you guys think the housing market would have done better or worse than stocks in that 100 to 200 year history? Tell me what you guys think about that. That's it for the video. Tell me guys, if you like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.